Hello and welcome to Business Today Television. I'm Siddharth Zarabi, and with me today on this episode of Market Masters is Mahesh Nandurkar, the Head of Research and Managing Director at Jefferies India. A very warm welcome to you, Mahesh. Thank you for your time, for joining in. Before we come to some specifics, I just want a broader political economy question to be answered by you to set the tone for our conversation. A positive surprise, Mahesh, from our politics, from our state elections, which is the return of the Bharatiya Janata Party for a third time. By all odds, it was not expected to return. And the result is that a lot of participants in the political economy are saying that the BJP is back and the momentum for the government, the NDA, is back. Does it translate into a significant enough event for our broader markets, Mahesh?
Here. To start off, it was definitely a positive surprise from the market perspective because investors clearly like to see a stable and a strong government, and the Haryana state election was one data point factoring towards that. So it's clearly a welcome step. I would say that it is an important event, but obviously I think it also highlights the same thing that we kind of witnessed, say, about 3 months back or so ago, that political outcomes are not fully predictable, and not even by the exit polls, which just come out just a few days before the actual results. In that context, I would say that the broader, investment community has kind of started taking, these not just exit polls, but the broader commentary running up to the elections also with a bit of a pinch of salt. But yes, it was definitely a positive development for sure.
And will that pinch of salt remain so for Maharashtra also, where the outcome seems to be more bullish for the BJP now, Mahesh?
Yeah, as I said, elections have become slightly tough for the markets to predict, as we just kind of discussed. So let's see, how it goes.
Absolutely. The commentary from our politics will continue, and that's the nature of Indian elections. It's happening every now and then. But let's turn to global macro factors, and among those is the risk of a worsening conflict in West Asia. We haven't seen it pan out over the past week or 10 days, but have our markets, just like domestic factors like elections, Mahesh, have our markets also now learned to discount international events and take them in their stride?
Good question, Siddharth, because in fact, that's what we have been seeing happening over the last couple of years. Actually, initially with the Russian-Ukraine conflict, and then obviously we saw events developing in the Middle East as well. So far, both those events have not really impacted the global equity market sentiment, also those in India. But what we're looking at obviously is, one more thing, as you rightly mentioned, there is a possibility of some kind of an escalation now in the Middle East, and we'll need to wait and watch what happens there. There are always, some possibilities, being talked about in Asia region as well. And, also from the global geopolitical perspective, and from the global generally sort of perspective, we are seeing US elections coming up next month. So variety of things to talk about from the global perspective as to how those could impact India. I think among all of these, what will be important to watch out for is obviously, as you rightly said, the potential escalation in the Middle East. However, we have seen the oil prices yo-yoing a little bit, went up from 70 close to $80, and then we are tracing that down, back again. Uh, the single biggest important factor from the Indian economic and from the market perspective is the impact that it creates on oil prices. But thankfully, over a period of time, I would say that the sensitivity of the economy towards oil has been going down, because the GDP growth has been around 7%. The oil volume growth has been about 4-5%. So as a share of GDP, the net oil imports have been falling. And our current account deficit is obviously getting a big push, not just from the broader services export, but specifically the GCC, the Global Capability Centers, as the new phenomenon is. So, on an overall basis, I would say that the the negative impact of a potential oil price hike, coming up from the events in the Middle East has also gone down. I would not really worry about oil prices too much till it reaches a price of around 100. So we are still quite far away from there.
Absolutely. What about China? The mixed signals that we are getting, and the disinflation story seems to continue. Economic data remains weak, and this comes in the broader context of what is happening in the global market. So, what kind of impact do you foresee from the most recent developments in China? Also, from a point of view of pullback, further pullback of foreign investors.
Right. So when we look at China, we have to look at it from two perspectives. One is the equity market perspective, and secondly, the economic perspective. Now, what has happened in China over the last, say, few weeks or so, the markets have rallied by as much as 25 to 30%. It's been a very, very sharp rally in actually still the largest equity market, in the emerging markets. And that has clearly had an impact on the foreign investor sentiments, in the sense that there has been a widening gap in valuations between India and China, and there has been certain section of investors that have moved very quickly to take advantage of this valuation gap in light of what was announced in China recently. But having said that, our house view is that at this point in time, the stimulus numbers, the package, etc., that has been announced in China is still of a very small value from an overall perspective. The market expectation is anywhere between 2 to 5 trillion RMB, worth of stimulus. So 2 trillion on the lower side, 5 on the higher side. So those are the numbers that are kind of expected. But what has been delivered so far is probably just a very small fraction of those expectations. Uh, but yeah, but even that alone has driven the Chinese markets up so much and has had some negative impact in terms of the foreigners pulling money out of India goes. My sense is that there will always be some part of the investment community that would like to exploit such short-term moves. But my sense is that India continues to be a long-term structural story, and a story that is much more predictable, both in terms of corporate earnings and in terms of government policies. So my sense is that there has been some small pullout from the foreign investors from the Indian markets, but the good part obviously is that we have a larger stabilizing force or a stabilizing factor in India, which is in the form of very, very strong domestic flows. And we continue to see close to $5.5 to $6 billion worth of money coming into the markets every month from equity mutual funds, and maybe another couple of $1 billion from other domestic sources. So that is clearly being the big support to the markets at this point in time.
Mahesh, given the quantum of money, 40,000 crore or more, uh, do you think the days of deeper corrections, perhaps exceeding 5%, are over for our markets because of the sheer volume of domestic inflows that keep coming in month on month?
That is true, Siddharth, and that is what we have been seeing, most recently in the last 12 to 18 months, that the market corrections bigger than 5% have been prevented because of such strong flows. My worry at the margin is that in this calendar year, in calendar year 2024, if you add up all the sources of inflows, including not just the mutual fund, but also the single stock purchases and also the insurance and the pension money that is going in,
Correct.
we are looking at almost $8 billion a month, right? And this is now for the first 8 months of the calendar year, for which we already have the data for. So this number annualizes to more than $90 billion a year. That's a very, very large number. And to put this number in the context of macroeconomic variables, a $90 billion plus of inflows from the domestic sources into the equity markets is more than 25% of the household financial savings, on an annual basis. It's a very large number. These kind of numbers are seen only in the developed market. So my worry at the margin is that whether such a high quantity of domestic flows that we have been seeing, will be sustainable. I'm quite sure about the fact that the domestic flows are here to stay, and will continue to be a big supporting factor for the markets going forward also. But this 25% of savings, or more than 25% of savings, looks like a really high number to me. And I have my worries, on that whether it will sustain at that level. Maybe a more sustainable number will be, say, close to $4 to $5 billion per month rather than 8 billion that we're seeing right now. Uh, but what that level of equity demand has also allowed, it has created an equally sharp response from the supply side as well. So we see large number of IPOs and QIPs and block deals from promoter blocks and the private equity blocks. All kind of supply has been coming in, and the current level of domestic flows has been able to absorb that very easily. Um, but going forward, if the supply remains where it is, it can cap the near-term market returns, and which in turn can bring down the level of domestic flows as well. So that would be my worry from the next 3 to 6 month point of view.
I just want to ask you, do you have a view on Hyundai, the largest public issue so far, all of the money being taken by the promoter? Is that a significant event for the future trajectory of our markets and inflows?
Yeah, in fact, Siddharth, if you analyze, even the kind of equity issuances that we have seen in the first 8 months of the calendar year, I mean, our data analysis shows that over these last 8 months, about $45 billion, worth of money was raised, during the capital market transaction. That includes, as I said, IPOs and QIPs and promoter block deals and private equity block deals as well. Now, of that, just about 20% or so, maybe 20 to 25% or so, was the amount of money that actually went into companies as a fresh equity capital. The 75% was in the form of existing shareholders selling down their stake. So, that money did not go into the companies, but it went into the existing shareholders. And that's what's likely to happen even going forward as well. That I'm sorry, the large part of the fundraising will be going into the selling shareholders, and that's the classical supply response. Because when we talk about a very strong demand for equities, companies to raise primary issuance, whether in the form of IPOs or any other form, requires more planning. But whereas these block deals and the secondary market sales can happen at short notice.
Absolutely, and that's a very important point that you made, Mahesh. Therefore, given all the political factors, the US election results that will come up in November, I want to ask you, for the markets, will a rate cut and its timeline, given what was said by the MPC most recently, be one of the most important factors to determine trajectory? And if you think that a rate cut is potentially possible, what will be the likely sectoral impact, Mahesh?
Yeah, I think we are in the rate cut cycle globally, and that has already been initiated by the US Fed. I'm sure it's a matter of time, before we see some kind of rate cut in India as well. But obviously, not to the level or not to the extent, to which US Fed rate cuts are expected. So the Fed has already cut by 50 basis points. And our house view is that maybe over the next 9 to 12 months, we see another 150 basis points. So a total of around 200 basis points. My sense is that the potential rate cuts in India will be a small part of that, maybe say about 50 basis points or so. So possibility of a rate cut maybe in the first quarter of next calendar year, and maybe another rate cut in the second quarter. So the extent of rate cuts in India will be much smaller in quantity, as such. But yeah, but having said that, those would definitely be a positive drivers. I would say for the usual rate sensitive sectors like real estate, NBFCs, and actually I would say even banks. Although one might argue that a rate cut is going to drive the NIM, the net interest margin compression for the banks, and
Hmm.
therefore, it's a negative. But I would say that that's a small negative as compared to a very tight liquidity environment that the Indian banking sector has been working under for the last 12 months or so. So I would say that even banks are looking very good to us from the next 12 months perspective on the back of this expected, slightly easier regulatory environment and easier liquidity conditions as well.
Mahesh, just one quick point. Are Q2 earnings, subdued earnings as we expect, are they priced in as far as markets are concerned?
I think to some extent, yes, but the worry is that because of the weak uh, data that we've seen coming through in the September quarter, and that was partially attributable to much heavier rainfall impacting various economic activities, and also we've seen uh, uh, sort of weaker data coming in from the other segments as well. So probably, I would say that some small amount of EPS revision in the downside is probably expected by the market, say about 1 to 2%. But anything bigger than that can have a negative, impact. I mean, as we've already seen in case of certain companies that have reported for this result season already, and there has been, let's say, disappointment on retail sales, etc. The stocks have seen a reasonably large corrections.
Mahesh, which sectors still look attractive to you? In the past, you've been bullish on several, including capital goods and infrastructure, for example. And I also want your comments on the EMS space, electronics manufacturing, and whether you see that providing us some of the winners for the future, not just immediate terms, but long term, maybe over 5 to 10 years, given that the PLI scheme seems to have spurred quite a few companies to do pretty well in this sector.
Yeah, I think from a long-term perspective, as you rightly mentioned, a lot of these sectors, such as the EMS and even the power utilities and the infrastructure and industrial and real estate, actually appear to me to be very, very attractive, bets to take from a 3 to 5 year perspective. Because our key call here is that India is on a on an investment upcycle, a very convincing investment upcycle. And despite the fact that the government might be slowing down a little bit, from its own side going forward, as the government capex as share of GDP probably has peaked out and maybe actually trends down from where we are, especially looking at variety of social schemes and cash transfer schemes that we are looking at the state level, but possibly even at the national level as well. But having said that, I think the private sector spending, the household sector spending on capex is actually rising as a share of GDP. So our view is that the capex cycle is clearly here to stay, and the best way to play that would be, as you rightly mentioned, some of the EMS names, some of the real estate names, some of the power names, etc. But I would say that from the next 6 month or so perspective, uh, given we talked about this broader equity demand supply equation just a few minutes ago, and the possibility that there could be some weakness in the market going forward, and many of the stocks in the sectors that we have discussed are some of the mid caps and small cap names which have rallied very hard. So while the long term appears very attractive, I would be on the sidelines on many of these names if I take a shorter term view, that is, let's say the next 3 to 6 months view. Um, and from the next 6 month view perspective, the sector that looks the most attractive from the risk reward perspective, I would say, financials, including even the large banks, the private sector banks, as well as the state-owned banks and the other financials as well. That clearly looks like the best sector to own from the risk-reward perspective from the next 6 to 12 months. So that would be my number one bet. We also are looking at very positively on some improvement in the bottom of the pyramid consumption trends as well. And I believe that the best way to play that is two-wheelers and telecom. So I would say banks, two-wheeler sector, and telecom is looking very attractive to us from the next 6 to 12 month perspective. But many of those other names which you discussed could be strong from a 3 to 5 year perspective.
What about PSUs? We've seen defense, railway, shipyard stocks see significant corrections, 40 to 50% from their peak. Is this temporary, or is that PSU story sort of come to an end for the near term at least?
No, I think the story is pretty strong. I would say, but yeah, but I would say that the story is pretty strong from the long term perspective. The short term perspective, the fundamental story is still strong, but given where some of the stocks valuation have gone up to, uh, in many of these names on the defense side or the railway side, etc., I would say uh, it would be it would be prudent to be sort of cautious with the next 6 month view. Uh, that's what I would say.
I want to come back to the earlier point, and this is about a private sector versus government capex. And uh, market observers, including yourself and many others, have consistently been talking about the private sector capex cycle. Expand on what you just said. Do you think the private sector capex has kicked in robustly and it will stay? Is that your reading?
Yes, very much so, Siddharth. In fact, I would say that there has been generally a misconception amongst many market observers or economic observers that the current capex cycle that we are looking at for the last 3 years or so is driven entirely by the government, uh, and if the government spending were to slow down, it will basically spell a doom for the broader capex cycle. I don't think that's the case. The government has clearly played a big role in driving the investment environment in India. But both the housing sector, which is the households, and the real estate sector, and the private corporates both have really picked up very nicely, according to me. In fact, as we speak, we are already in the middle of a private sector upturn on the investment side. I would say that barring only one industry, which is the refining and petrochemicals, which is where we are not really seeing large capex being planned. But that's also in line with what the global trend has been. We're talking about green transition, etc. So in that context, there is, understandably, some question marks on expanding and investing in a big way in refining petrochemical. But apart from that, whether it is steel or cement, or autos or power and other infrastructure, segments like airports and seaports and so on, the private sector spending and private sector investment is visible across the board.
Correct.
So it's very much there.
What about the information technology sector? And there is a Jeffrey's report also on the slowdown weighing on formal job creation. But let's leave that aside. TCS numbers are known to us. Other numbers coming in. What's your sense about the IT sector?
I think that's a sector that we have been, under sort of, we've been underweight for quite some time over the last 12 to 18 months. Continues to be the case even today, because ultimately we are looking at a sector where the corporate EPS growth has been in single digits, maybe 8 to 10%, 10% on the higher side. Whereas the trading multiples have been almost three times the EPS growth. So that's almost like 3x, on a PEG basis. Um, but having said that, also more fundamental story in the IT services sector is predicated on the US corporations' discretionary spending. And we are not really seeing any signs of that discretionary spending from the US corporates actually going up. In fact, the 50 bips rate cut by the Fed and maybe more rate cuts going forward is actually driven by the fact that the corporate spending and the broader economic outlook, in the US is actually worsening and not improving. So, in that context, I would continue to stay, underweight on IT sector. Maybe there are certain, interesting bottom-up ideas that can be looked at, but at a broader sectoral level, we will not be bullish there.
Okay, I have some questions based out of feedback that I am getting in. I'll try and run through them very quickly in the next 3-4 minutes. How to identify future winners, particularly anything that you see in the semiconductor space, Mahesh? This is one topic that's just come in.
No, that sector is, very, very, attractive, and I think the government is clearly moving in the right direction because, we clearly need to be self-reliant, in that space as much as possible. It's a very high growth space, and I mean, right now we are looking at, oil imports at around $120 billion on a net basis. The electronics imports are half that level, but growing rapidly, and unless checked in time, it can become the next oil, and obviously we don't want that. And thankfully, the policymakers, the regulators are also very well aware of that. So it is a very, very interesting space for sure. And there are, companies that are, making some big plans. Some are listed, some are unlisted. So, I mean, I'd not be able to go into individual stocks here, but that space looks very attractive for sure. From a medium to long term perspective.
Another one, any winners that you see from India's continuing infrastructure build out?
Oh, that's for sure. In fact, that is really the core thesis for us. And there are several interesting infrastructure stories. I would say airport story is looking very, very interesting. Because the airport infrastructure is growing quite rapidly in India, and there is requirement for that to increase even more from where we are. There would probably be more airport privatizations as well. So that space looks very interesting. Power is the other one. So power is clearly a very strong, theme because there is a significantly high utilization rate for current power capacities, and that is only going to increase over the next 5 years. So power story, be it in the form of generation or transmission or distribution or financiers or equipment supply, the whole chain in the power looks very, very interesting. But as I said, some of these names, would probably deliver returns over the next, say 2 years to 5 years. In the short term, one just, needs to be a bit cautious.
Okay, what are your year-end targets for the Nifty, Mahesh?
Oh, year-end targets have already been breached. Let me put it.
Okay, that's a good one. So I'm going to end with another feedback question, and I'm being asked to get you to tell us, when do you think the Nifty will hit 50,000?
Okay, that is, not that difficult a question. I mean, we are already at about 25,000. And I definitely believe that Indian markets would be delivering, a strong double-digit returns from here on. So, just back of the envelope calculation suggests that in the next 5 years, we should be seeing Nifty at 50,000.
Absolutely, Mahesh. And that brings us to the end of today's conversation. Clearly, it seems like, at least from what I have understood from what you said, that there's going to be a forever Diwali for Indian stocks, but caution and sensible investing and listening to market masters like you is perhaps the best way to go for India's burgeoning investors of all shapes, sizes, and quantities. Mahesh Nandurkar, as always, a pleasure speaking with you today on this episode of Market Masters. Viewers, we'll be back with more expert insights from people like Mahesh over our next episodes. Do continue to tune in and do listen into this conversation. Provide us your feedback and questions for future conversations by watching this entire interview on our social media platforms. I'm going to say bye for now with the promise that we'll be back very soon. Take care.
Would you ever sit in a driverless cab by Elon Musk? Here's what he's planning with robo-taxis, what everyone in the tech world is calling Tesla's iPhone moment. One of the biggest in a decade. Let me break it down for you.
As the butterfly doors